Let me save you from the most expensive mistake that I see new triple net buyers make when they're looking at a triple net lease property. Often when people look at a Dollar General, they look at a higher cap rate and they think that is a better deal. But a higher cap rate often is the market quietly telling you that there's more risk than what you're aware of. And if you don't know where that risk is, you can buy a deal that looks good on paper, but then becomes stressful the day the lease gets shorter. Hi, I'm Rene Nelson. I'm a CCIM and commercial real estate broker, and I help people buy triple net properties like Dollar Generals, Jack in the Box, Circle K stores, things like that. And today I'm going to share with you some information on how to look at cap rate in comparison to how a property performs. I own a Dollar General store myself, so I understand the appeal and the questions because I've been in your shoes. Most people watching these videos are not subscribers, and it's super helpful if you would hit subscribe. It increases our algorithm and it allows me to reach out to other investors like yourself and prepare more content in the future. So please hit the subscribe button. Today, we're going to build on the last topic on how lease term drives pricing. And we're going to go one level deeper. And I'm going to tell you how a higher cap rate is a gift, but it can also be a warning sign. So if you're watching this because you want steady income and simple ownership, I get it. I understand. When my husband was passing away 3 years ago, that was one thing that was important to him. He wanted to know that I had stable income coming in so that I could go and travel and enjoy things that I wanted to do in my life. Luckily, working with great people like you is one thing that I'm passionate about because I feel like I have this information and knowledge and I want to share it. A lot of investors like yourself are tired of market volatility, constant decision making, and properties that make them feel like they have a second job. The goal is financial stability and predictable cash flow and a clear plan where you can live with it. Net lease properties can be a great fit to reach that goal, but only if you buy the risk on purpose. Let's start with plain English definitions. Cap rate is the relation between income and price. At a basic level, the higher the cap rate means the lower the relative price to the income. And a lower cap rate means a higher price relative to the income. They're basically inverse of each other. But the part that matters the most is this. The market often price risk through the cap rate. So when you see a higher cap rate, your next thought should be, what risk is the market pricing into this? I want to make this simple and usable. You do not need to research every local market or figure out a perfect replacement property to screen a deal. You can look at first blush with the first pass by using the offering memorandum or the listing broker's marketing package. Focus on 3 numbers and ask yourself one question. Focus on the remaining years on the lease, the actual annual rents shown in the offering, and the market cap rate at the asking price. And then ask yourself one important question. What is my next exit plan and who is my buyer when I sell? That's super important. So let me repeat that again. Ask yourself, what is my exit plan and who is the buyer that will buy this when I am ready to sell? Here's the truth that I say out loud because it changes how you evaluate every deal. No one can guarantee a tenant will renew a lease. So you are not buying a promise. You're buying an income stream and you're buying a contract for a period of time. Your job is to decide if the price matches the amount of time you are buying. Now, let's talk about the warning signs and the reasons a cap rate can be higher. I'm going to give you an easy checklist. These are not complicated, and most of them are visible in an offering memorandum or marketing package or in a quick call to the listing broker. Warning sign number 1, the lease term is getting short. Lease term is the biggest driver of a perceived certainty. When you see a cap rate, check the lease term and the lease expiration date first. If you're within 5 years of expiration, you are approaching a decision point you do not control. Dollar General controls whether they're going to renew that lease, not you. So you have to ask yourself, am I willing to take the risk and will they renew? That doesn't mean the deal is bad. It just means that the price needs needs to reflect that uncertainty. I've had several clients who have built entire retirement portfolios by buying Dollar Generals that had very short-term leases left, and it offered them high cap rates. They knew they had 3 to 5 years left on their portfolios on these Dollar Generals, but it worked for them because they were able to buy multiple properties. Since the price points were lower, they could buy an entire portfolio rather than buying one Dollar General. And the other thing is that you want to look at, because this is one thing that I see, someone buys a deal with 6 years left because the cap rate looks attractive, but they hold it for 3 years. Now they're trying to sell a Dollar General with only 3 years left on the lease. That buyer pool is super small and the pricing often softens. And now you really have to give up a lot in the price incentive. So if you don't plan for that in advance, you can lose money on the exit, even if the income looks good on day one. My client that bought that portfolio, it was a husband and wife team. Their strategy was they were going to buy and hold and ride the wave, even if Dollar General did not renew. Luckily, Dollar General did renew on their properties, but their plan was they were buying multiple properties, going to build this retirement portfolio. And then as these staggering leases became renewable with Dollar General, they would renew them. Their plan was not to panic and just sell off. If you do that, you're going to give up a lot of your profit margin. And I would recommend that you don't buy a Dollar General because I don't think it's the right risk and the right portfolio product for you. There's other things out there that you could consider. Warning sign number 2 is when the cap rate is high because the liquidity is lower. Liquidity means how easy is it to sell this asset to the next buyer. A Dollar General in a major metro area with long-term often has more than one buyer looking to buy it. But a Dollar General in what we call a thin trade area or a small little town with a very small little market, it can still be a solid investment, but it usually has fewer buyers. And fewer buyers means that the market demands a discount. And often that discount shows up in a higher cap rate and a lower price. Warning sign number 3, the deal is priced for a quick buyer, not a long-term owner. Sometimes you'll see an offering that is positioned as a high cap rate opportunity and the market is focused on yield only. Anytime the story is only about the cap rate, I slow down. I ask, what's the term? What are the options? What's the exit plan? How long has Dollar General been there? How many other dollar stores are in the area? How many rooftops or people live within a 3 and a 5 mile radius? Because a good deal can be explained from far more than one angle. Warning sign number 4, the lease structure has friction. Most Dollar General leases are very straightforward, but you still want to look at the basics. How much time is left on the primary term? Are there options to extend? Do the rent increases occur? And if so, when? Is it a true triple net in the way the offering describes it, where the landlord has zero responsibility? Dollar General is responsible for not only the taxes and the insurance, the maintenance and repair, but also the parking lot as well as the roof. And again, you do not have to litigate every clause during the initial screening. You'll spend a lot of time, and probably by the time you get ready to make an offer on that property, it's going to be gone anyway. But you should know what you are buying and whether there's any unusual nuances that a future buyer would also hesitate about, because that's going to be who would buy the property from you in the future. Warning sign number 5, the property is trading like a bond and it's not priced like a bond. Some buyers think triple net is the same as a bond with predictable income, low risk, done. It's not the same. It's a real estate asset with a lease attached to it. If the deal is priced tightly, but the term is short or the buyer pool is thin, you're paying bond pricing for non-bond risk. And that's where people often get hurt. Now, when there's a higher cap rate, is that a gift? Here's where a higher cap rate can often make sense. One, when you are intentionally buying shorter term because you want higher yield and you have a clear exit plan. Like my client that did it in the past, he had a clear plan and he knew exactly what he was doing. Number 2, you're comfortable holding through the next decision point and you have reserves and patience if the outcome is not perfect. And number 3, the deal is priced correctly for the risk, meaning you are being paid for the uncertainty that you are taking on. Here's a quick test that you can run in 60 seconds. I call it my 3 timeline test. Timeline Timeline 1 is today. What is the actual rent in the offering? What is the cap rate? And how much term is left? Timeline 2, what is your holding period? If you hold it for 3 years, how much term will be left then? If you hold it for 5 years, how much term will be left on the lease then? And timeline number 3 is, what's your exit plan? At that future point, would a buyer feel like they're buying stability or buying into an expiring event? If a deal only works if you assume an easy renewal, that's a red flag. Your underwriting should work even without a perfect outcome. Now, I want to make this personal for a moment. I own a Dollar General because I wanted simplicity and predictability. I wanted income that did not depend on constant management decisions and my involvement. That transformation is real for a lot of us investors, and it gives us fewer headaches and steadier cash flow and really a clearer path for planning in the future. But the way that you get that outcome is not by chasing the highest cap rate. It's not by buying the highest cap rate possible. It's by buying the right amount of term for your goals and paying the right amount for the risk. So what should you do next if you're looking at a Dollar General right now? Here's the process I recommend. First, screen by the term and the cap rate together, not by the cap rate alone. Second, decide your minimum term requirement based on your risk tolerance. And third, align your hold period with your exit plan so you're not surprised later. If you want any help applying these real deals, I've created a guide called How to Buy a Triple Net Property. If you're watching this on YouTube, it's linked in the description. And if you're listening on a podcast, you can request it by going to my website, eugenecommercial.com. Download the PDF, review it, and then schedule a free 15-minute discovery call with me. We'll walk through your goals and decide what level of term and risk fits for you. And if you want, I can even help you analyze a few Dollar Generals to see which ones actually match your next buy box. Let me leave you with a thought that matters most. A higher cap rate is not actually a better deal. Most of the time, it's market pricing and something that you need to understand. Buy the term that fits your goal, price the risk honestly, and have a clear exit plan from day one. If this was helpful, please hit the subscribe button and hit the thumbs up. It helps the algorithm share this with other investors like yourself and allows us to continue to create great content. Thank you for watching, and I'll see you in the next one.